Yeah.
So that's what I want to know, whether you can answer it or somebody else, that's
Yeah.
my question.
And that's always a horrifying feeling. And I think we have someone here that can give you some wonderful guidance on that, because I think they deal with that all the time. I know I oftentimes come in after the fact and deal with the probate issues and whatever. So I oftentimes don't get that immediate call, but I think you're going to get the answers that you need. So I'm going to kick that question out because I think there's someone better suited to answer that.
Awesome. Thank you, Brad.
Yeah,
Thank
very
you,
good.
Noah. Appreciate
Very
that. Let's
good.
give them a hand, you guys. Thank you. I assume they're going to stay until 11 p.m. tonight. That's right.
Yeah.
We'll keep them here. So next I want to introduce Mr. Chris Janssen. He's going to come up. So Chris works for Thrivent financial advisor, and he works here in Rice Lake. He's a member of Our Lady of Lourdes Church here, a part of our cluster. And he'll share a little bit more with you about the financial planning side of things. So take it away, Chris.
Thank you, Emily. Well, thank you everyone for being here. Thank you, Brad and Noah, for that as well. I'm glad that you guys are going to be here till 11. I will not be. I ran a little bit short. I wasn't sure of the amount of people, so I love the interest that we've got here tonight. What I just handed out is just something that I use in my practice when I'm kind of meeting with folks, just from planning and just kind of getting an idea of where assets may be from a tax standpoint. So I think we've probably all heard the old adage, there's two things in this life that we know are for certain, and what are they?
Death and taxes.
Death and taxes. Benjamin Franklin. I will talk about both of those things today, so that's exciting. The two things that we all want to talk about. But so, like Emily said, I'm a financial advisor. I work with Thrivent, and the way that I usually kind of start these types of presentations is just to say, I really believe in the idea of having a team that meets with you about your finances, and that team should consist of primarily three relationships. Number one is going to be an accountant. So who does your taxes for your specific situation? If it's individual taxes, if you have a business, if there's corporate taxes, whatever that might be, they're going to know year in and year out what the current tax code is. The second relationship is the relationship with an estate planning attorney. Those estate planning attorneys are going to be really knowledgeable about end-of-life issues, about what's going on with trusts or the will or healthcare powers of attorney and those types of things, to make sure that you can do the things that you want to do upon first death if you're married, and second death if you're married as well. And so that's kind of another relationship. The other is with a financial advisor, and that's kind of where my job comes in, to kind of bridge the gap between the two of those relationships. And so primarily what I do in my practice is I help folks get ready for retirement, save for retirement, plan for different risks that might be out there. And we've talked about a lot of those already. And in the short time that we kind of have available today, I just thought, gosh, what am I going to talk about? What are the things that I want to just talk through? And in the 13 years that I've been doing this, I think the biggest opportunities that I see come with taxes and the planning around what happens at first death if we're married. That might not be everyone's situation, but I'm going to spend a little bit of time there. For those of you who didn't get the handout, my apologies. It's the same thing that I've got up on the screen here, so I tried to get the ones in the back in case you couldn't see this. From a tax standpoint, any asset that you own is going to be taxed one of three ways. The first column, that column on the left, is tax now. So they're savings accounts, checking accounts, non-qualified or jointly held mutual fund stocks, bonds. Your home might be in there as well. You pay taxes on your home every year. And what happens is that you pay taxes as you go. It resets the clock every year. It shows up on a tax return. The second column is where I see probably the most opportunity for planning, and also from an estate planning standpoint, sometimes where the most misunderstanding comes. But that's for tax later assets. So anything that you put into that column, especially if it's in a traditional IRA, that first one, a 401k, if you have a pension, all of that shows up whenever you take it out as 100% taxable. So we know that there's just no way of getting around paying taxes. Other annuities and those types of things offer tax deferral as well. And then there's that third column way over on the right, or tax never. Okay? Now the tax never, there's a little quotation mark there. It's not that we never pay taxes, but what it means is that once money has gone in there, the money that's funded it has already been taxed. So that's not going to be taxable when it comes out. But then whatever it grows to and whatever investment vehicle it's in is going to be tax-free if structured correctly. Okay? So the biggest thing I think when I meet with folks, number one is just with the IRAs and how do we protect things. And so sometimes trusts can get used. But the issue is a lot of times people say, and I worked with a client, actually I'm working with a client right now this year, who they did a will, they actually did some trust work years back, maybe like 20 years ago. He is now in his 90s. She passed away. They're getting nursing home care. He is. And he was under the understanding that every single thing that they had and the planning that they'd done went through their will. And so their will was going to tell them exactly where everything went. He forgot and he didn't understand completely that other assets like IRAs or life insurance have their own beneficiaries. So I think we've kind of covered that, but it's just one of those things that I want to make sure people understand. A will only gives direction on where non-beneficiary related assets are going to go. Okay? So it's really important that if you have those type of assets and you haven't done planning in a while, that you review who are the beneficiaries. I meet with a lot of folks a lot of times who they had a life policy or something that their parents took out. Their parents were listed as beneficiaries. They now have a family and it's never been updated. So update and look at your beneficiaries and all those. But the other thing here that I use kind of goes through a program that I use in my practice called a what if tax calculator. And what this does is it shows us where our assets are today, how they're being taxed, and then it allows us to help people plan for what happens later. So if I was just to throw out a question right now, and we think about taxes historically in our country, do we think that right now with our current tax code, do we feel like taxes are higher or lower than they've been in the past? Anyone can shout out an answer.
Lower.
What was it?
Lower.
Lower? Anyone else? Lower is the right answer. Historically speaking, we've got some of the lowest tax rates we've ever had. Okay? We have the biggest population that is turning 65 and is starting to take from programs that are funded with tax revenue like Social Security, Medicare, and all those types of things. And even before the pandemic, we had about 19 trillion in debt from our country, and now we've added a ton more. So the likelihood of taxes coming down in the future, in my humble opinion, is pretty low. But a lot of times people have said, gosh, I've put money into this middle column that I don't have up there anymore, but they put that money in that middle column, they say, I don't even want to take it out. I don't have to take it out. I just want to continue to defer it until a later date and just punt it. And what this program allows us to do is to say, hopefully for people to say, maybe stop punting on taxation. Maybe start thinking about taking money out. And here's really, I think, the biggest thing. You're going to see Gerald and Judith Janssen. For those that know me, those are my parents. This is not their information, but I stole their information to kind of get into the program here. So I think the biggest piece of this, and this is going to show a couple of different things. And again, this is not everyone's situation, but it is just to kind of get an idea of, let's just get thinking about what do we want to do? Because the Lord, at the end of the day, has blessed us all with whatever assets we have. And He's called us to be good stewards of those assets, and that's why you're all here tonight. And so what this is showing here is kind of where the tax rates fall today. And this is a hypothetical couple. I'm going to get to kind of the inputs. But our first bit of income, and I'm sorry if this is a little bit small, is taxed at 10%. And then it goes to this next, that green part right there is 12%. And then the next one up is 22. So there's kind of a big jump federally speaking from 12 to 22. And a lot of times folks, when they're in retirement here, what we're going to see is they're usually maybe in a 12, maybe a 22, but if I go down to the inputs, and this is a long section, so I'm just going to kind of go through this part just so we can see where we're at. 72-year-old couple, we've got 30, so we're not working anymore. So in the actual column here, we can see we've got 0 bit of wages, and so actual and retirement are the same. So $30,000 of IRA distributions, okay? Primarily those are going to be coming from RMDs, or required minimum distributions. We have, in this situation, we have pensions and annuities of $30,000. So maybe not everyone has pensions, but I see this a lot where we also have some pension income. And then we also may have Social Security benefits, and in this case that's $45,000. What you're going to see is the taxable amount of Social Security is pretty high because of those income variations. But the biggest thing that people don't think through is, well, what happens to our assets? What happens to our taxation when one of us passes away? Do we think income goes higher or lower when one passes away?
Goes right down the toilet.
It goes lower, it goes lower, but it doesn't go necessarily down the toilet. Okay, I'm going to explain this in a second. Our income may drop, our income sources drop. What happens to Social Security checks if one passes?
The higher one.
Yes, you keep the higher of the 2 checks. A lot of people don't know that. So if there's one that's a lot higher than the other, the higher one is staying. So regardless right there, the income isn't getting cut in half, it's still going to be up a little bit higher. It's going to be lower, but a little bit higher. Do we think that required minimum distributions, or those monies that we have to take out from that middle column, do we think those go higher, or do they go lower, or what happens to them? I heard a lower, because you've got less in the IRA. Anyone else? It's worth thinking about. It's a decent answer, but it's not right. If we have an IRA for him and an IRA for her, and the spouse passes, those IRAs still exist, and more than likely you can just treat it as your own. So we've got the same account value, and the RMD figure is exactly the same. So that income stays right where it is. I've got calculators that can show this as well, but likely what happens is if those IRAs are invested, they're also growing in value, which means the IRA dollars or the RMDs are also going up. The pension in this case, I just assumed in surviving spouse, in that column, what I'm going to show, and this is what the program just allows us to kind of put different inputs, but I said I basically kicked one of them off and I said, Mom, you're dead, okay? So Mom's gone, and so what's the situation look like? The RMD or the IRA distribution stay the same, assuming that the RMD is still invested. What happens is pensions and annuities, if they're both receiving pensions, I just assume this is very simplistic, maybe half of the pension's gone. Okay, maybe we didn't choose a life income. And the Social Security I just cut by $20,000. But what happens is you're going to see the surviving spouse tax rate is now 22%. So our income, yes, it went down, but the tax rate on those taxable dollars has gone up by 10%. So when I meet with folks, I really want to hammer this point home of if taxes are going up, and I'm going to go back up to the picture. I went through the numbers for those that like the numbers. The picture shows it a little bit better. Yes, our income came down, but we're in the gray box. We're at 22%. So my point in all of this is end-of-life planning is really important to do estate planning to make sure it gets passed correctly. But taxation, and I can't give tax advice because I'm not an accountant, right? And I've always got to give that disclosure. But let's maybe think about taking money out of those IRAs now if we are married filing a joint tax return, or even if you're single, fill up your current tax bracket with taxable dollars if possible, and either A, spend them, you saved them. If you're over 59 and a half, go and spend them if you need to spend them to live on. Number 2, if you don't need them, great, still consider taking them out and putting them somewhere else in one of those other 2 columns that I show on that thing, on the printout there. Or number 3, give them away. If it's likely that you're not going to spend all of your assets, not everyone's in this situation, but if you're not going to spend them, give them away. There's a lot of different ways that you can be charitable in your intent. The only way of getting around taxation in that middle column of the IRAs is giving it to charity. I'm not saying go ahead and give all of it to charity, but if you give it to charity, they're not paying any tax on it. And the current legislation for the tax code allows you to still give what your RMD would be if you're not going to spend it as a qualified charitable distribution to a nonprofit organization. Maybe that's the school here, maybe that's the church, maybe that's a different nonprofit of your choosing. But at the end of the day, God's called us to be stewards and is calling us to say, if you don't spend it all, make sure you're not only being a good steward with what happens when it passes to family, but also maybe consider giving some of it away, because there's a lot of really great things out there that you can be benefiting from it. The last point that I'll make is this. A lot of people want to be really private about their money, and I totally get that, and you shouldn't, like you guys said, you should maybe want to keep some of that private. But when it comes to your family, and if you have kids, I meet a lot of folks that just don't want to talk about money or what they're going to have to their kids. And I get that, but I want you to push against that a little bit and have open conversations with your kids about what your intents are and what they might be inheriting, because it also may affect their situation. And so I always encourage folks to just start having difficult conversations. We never want to talk about our own death, but the reality is none of us are getting out of here alive. We also don't always want to talk about money, but it's one of those things that we've been given as a gift, and God is calling us to use it for good. And our kids are going to be a great good. But if you've got 3 kids, the 4th child is going to be the IRS in some of this. And pay to Caesar what is Caesar's, for sure, but there are ways to minimize what Caesar may get. So that's my part of all of this. This is a little bit of it. Questions on anything? I know that we've got some other stuff that we want to get through tonight too, but yeah, go ahead.
I got the impression from what different people said here that you have a choice as to when your spouse dies, that you have a choice of whose Social Security you're gonna get. I didn't have a choice. They just gave me some of my husband's.
Okay. And if that's the case, you may not have felt like you did have a choice, but his may have been higher, so you would have gotten the higher of those.
I didn't get I didn't get the full amount that he got.
No.
Okay.
You did?
No.
Then go see Social Security.
Exactly. Make an appointment with the Social Security office. Get it straightened out.
And you probably will get that.
I'll give you their telephone number.
There you go. They've got a great office in Rice Lake. They're good. Anything else? Yeah.
Gil, you talked about your team, your
Okay.
finances.
Yeah.
You know, the attorney, the estate planning attorney, or the accountant, estate planning attorney, and a state
Yes.
financial advisor. Should you go to one of those? Who should you go to first? Is there an order that you should?
I don't know that there's necessarily an order, and I'm not going to say this because I'm the financial advisor, but I think it could make some sense to go to the financial advisor, because they can at least get a lay of the land. And I only say this because I currently don't charge per hour, and so I can help get a lay of the land of where everything is, and then say, you know what, when you're going to start retirement and you're going to start income, we're thinking about this taxation, go talk to your accountant. If you haven't met with an estate planning attorney, let's definitely get those things set up sooner than later, and so let's meet with them as well. Those 3 relationships are important, but if they're not talking to one another, that's also not very helpful. Okay, because we could be doing planning in 3 different areas that aren't actually meeting the final goals. And so if they can at least be talking and meeting together, I think that that's important too. So there's not a right or a wrong answer to that, but I would say maybe the advisor first. Good question. Anything else? Go.
All right, thank you, Chris, very much. And we're done. They're staying till 11 o'clock, so plenty of time. Oh, you're not.
He's maybe at home.
We'll let Chris go. He does that. He does
I'm just
it.
kidding. They're not.
Well, I wanted to introduce John. So John works for Appleyard's Home for Funerals here in Rice Lake. He has been doing this for, what were we talking about, 35 years?
35.
So I would call that an expert. What was that?
He's too young for that, do that.
Well, he's been doing it a long. You want to tell him how old you were when you started? You told me.
18.
Yeah.
See, I said you had to be 16.
Almost. So yes, I've owned Appleyard's Home for Funerals since January of 2010. I've been a licensed funeral director since 1992. And how I got into the business was just a fluke kind of a thing. In high school, I grew up in Minneapolis, and all my aptitude tests would come back as a funeral director or a counselor in that kind of category. And when you're a sophomore in high school, you're like, that's kind of a creepy job. Let's try something else the next year. Well, the next year then I filled out my questionnaire and I was trying to change my answers so it wouldn't come up as the same kind of a occupation as, but I had to be truthful with myself. And so I think just down in my heart, I just always wanted to serve other people. So when I moved here to Rice Lake, I lived with my grandma, started working for the funeral home, went to college here in town, and I've been there ever since. So I just think I'm doing what God has planned for me to do. So I just did that call, and I think that piece of paper, that test that I first got has always come as this. So for me as a funeral director, I'm usually there to help you through every step that you possibly can take. Some people do pre-plan